The most shocking thing was Jerome Powell basically saying the Fed does not need to. They do not need to get to 2% to start cutting rates. And that's a big change, right? So that basically opens the door to springtime, summertime rate cuts if they want to, right? Thought process before was they need to be at 2% and probably at 2% for at least a few months before they cut. Now it's like, well, maybe if they get down 2.7%, 2.5%, 2.4%, they'll cut, right? And so that's big. That's a big change in kind of what they're up to there, right? If rates are going to truly go down, mortgage rates going to go down, guess what? Inventory will start picking up quite substantially, and the home builders will start having some competition there. Now it seems like there's a lot of competing services. I even see Meta has some products out there. They'll basically, you want any type of image to look a certain way, you can basically draft up, and I think those are just going to get better and better. And so you do have to wonder, is that somewhat of a competitive threat to Adobe? Are there other places Adobe's going to be, let's call it disrupted over this next 10 years? So Adobe's a really great company, but I am at least a little concerned with that. In a light fiscal year 2024 revenue and EPS guide definitely kind of gets a little more into the fear about, are they being disrupted right now? So, folks, I am in shock. Absolute shock. I just wanted to listen to that alone and kind of focus on that. So I threw it up there for you guys. Jay Powell talking there, but I really just want to focus in on that. By the way, hello, chat. Hello. I'm in shock right now. And the reason being is Jay Powell basically just said, and that's why I typed in the chat after he said it. I'm shocked with what he just said. He basically said we don't need to get to 2% to start cutting. And that's a very different kind of tone or thought process than he's shown in the past. So now it is on the table of cuts in the first half of the year, because now he's basically saying we don't even need to see 2% to start cutting rates, which was pretty shocking to hear. And I'm glad Jeffrey Gunlock also picked up on that as well. He said, if I heard him correctly, he said we don't need to get to 2% to start cutting rates. That's news to all of us. Basically the way he's led on and the Fed's led on is we need to see 2%. When we see 2% consistently, then we can worry about cutting. And the fact that, wow, what a statement. Okay, let me get everything up here and rolling. Then we'll start talking about the market, what's going on here, and all that good stuff. But man, that was the most shocking statement by far that he said.
Which is really interesting, because I think that all this money that's in money market funds and that might be over-allocated to other assets than bonds and institutions, I think the logic that people have that money market bloat is going to go into the stock market is wrong. I think it's unlikely for investors to go from risk-free 6-month T-bills to the Magnificent Seven at massive PEs and all-time highs on the Dow Jones Industrials. I think they're much more likely to go from their mountain of cash in T-bills into bonds. And so I think that the strategies that I've outlined in the past couple of times we met, which have been this mix of credit in the middle of the capital structure and long-term treasuries, I think you stay with it for now. I've been thinking about that movie Braveheart, where they're about to attack, and the Mel Gibson character is saying, hold. They want to fire or do whatever their assault is, but they have to wait for the right moment. I think you have to wait for the right moment to alter this bond strategy. And that right moment will be when the recession comes.
Maybe some of the money in money markets is split. Maybe some goes into bonds for the very reasons you suggest. Maybe some goes into stocks because they see the possibility of a powerful new bull market developing. I'm going to go to, hang on just for a second, Jeffrey. Steve Leisman's just stepped out of the room, and I do want to go to him because, Steve, this was extraordinary on a number of levels, I think. Number one, the Fed chair in his news conference did nothing to walk anything back from the statement. He did nothing to hawk it up, so to speak. And I know he sounded like it would be premature, and he said as much, premature to declare victory. There was no jumpsuit, there was no aircraft carrier, but he doesn't seem like he's that far away either from doing just that.
Yeah, I think this was a pretty big day, Scott. I think that the Fed pivoted today. I think it went from having this bias to hike to being in neutral with a forecast to cut rates. And I think that's a pretty big deal. And he acknowledged in response to my question that, yeah, they sat around the table today and yesterday, and they talked about rate cuts. Here's a quote from the press conference.
the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view and is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Scott, I thought the chair might have tried to hold back the water on the dam one more meeting. I guess the data yesterday and today, especially the PPI and what it says, he mentioned this specifically. We talked about it on your show at noon today. What the data today says what's going to happen to the PCE numbers next week made it kind of untenable for him to hold back and to maintain a position that was too hawkish. And just real quick, we have been talking about this number that Jeff was talking about, this CPI ex shelter, which has been below 2% for several months now. There's that number right there. You can see it. It's down below 2. And then, okay, so it's not fair to take shelter out. The reason you take shelter out is because the shelter in component they use there is lagged about 3/4, Scott, from some of the other market-based indicators that are out there. And if you fold those in, you really don't have a problem. It may be that the Fed is already there. And the concern was that the Fed would keep rates high and depress the economy for too long based on bad data.
Steve, I appreciate it. Quite a day that I know we're going to be talking about many more times in the days ahead. That's our senior economics reporter, Steve Leisman, just out of the news conference with the chair. Back to Jeffrey Gundlach, who's with us exclusively, of course, from Double Line. So, Jeffrey, how come you're not willing to go as far as to say, you know what, I no longer think that we're going to have a recession? I'm wrong at this point. The economy is better than I ever thought it would be at this point. Inflation's come down much quicker than I ever thought it would be at this point. And you know what? Maybe the Fed's going to pull this off after all.
Well, I don't think inflation's come down faster than I expected to. It's really followed the trajectory pretty closely, and it's going to continue to fall further. I just think that a lot of the way the market works through cycles, I thought is so often the case. Brian Kelly, I think his name is on that segment before the announcement is read.
I know you're talking about David Kelly, and he was talking about a pivot that he saw, that this was a pivot today.
Yeah, not just that, though. He points out that when you first start raising rates from low levels, it doesn't have a real market damage. But then, similarly, when you start cutting rates from high levels, you start to affect the economy in a negative way, somewhat counterintuitively, because people might wait for lower interest rates if they think they're coming to do things that can accelerate the deterioration of the economy. And also, the Fed themselves is projecting a 4.1 unemployment rate, which would be up about 70 basis points from the low. And whenever historically the unemployment rate has gone up by over 50 basis points, it tends to accelerate from there to a higher level. It goes into another gear. And it's very consistent historically. I think there's a contradiction between the dot plot of the unemployment rate going to 4.1 and history. So I think that the Fed's going to be wrong on the low end for the unemployment rate for 2024. And I think that once you get the market de-inverting the yield curve and you start to really get the bond rally cemented into the DNA of investor psychology, I think that's usually the peak in risk assets. That's why I say it's okay now for the Braveheart idea of hold, but you're going to have to pivot. And I think you have to pivot in a very intense way in both stocks and bonds when we get into the next recession. Maybe I'm wrong and it doesn't happen next year, but I think the odds have gone up, not down. We saw GDP now was about 5% or so in the third quarter, and it's now running, substantially less than that, and we're talking about maybe 1% next year. And I just don't think that's the way the economy works. Just like inflation overshoots on the upside, it overshoots on the downside. I think that the economy is going to undershoot on the downside, and the unemployment rate's going to go up, and that is going to create a totally different response. We're going to have to have a lot of money printing, I think, to battle the coming recession, and that's why you might have to pivot across the board, because the inflationary consequences of that could be very substantial. So this is a long view type of thing, but for now, I think the Fed's pivot needs to be digested by the markets. And obviously, a lot of that digestion happened today. And we'll see how the rest of the week plays out, because that pretty much takes us till the end of the year.
I want to sort of get your overall assessment of this Fed, because I remember so many of the conversations that we've had through this calendar year, ones where you've suggested that, Powell was Mr. Magoo, going to drive into a wall. Other times suggesting he was up on this ladder and it's time to paint or get off the ladder.
Yeah. Yeah, that was at the beginning. Yeah.
And here,
I was curious what Gunlock had to say in kind of his stance on this. So, if you missed what I said earlier, the most shocking thing was Jerome Powell basically saying the Fed does not need to. They do not need to get to 2% to start cutting rates. And that's a big change, right? So that basically opens the door to springtime, summertime rate cuts if they want to, right? Thought process before was they need to be at 2% and probably at 2% for at least a few months before they cut. Now it's like, well, maybe if they get down 2.7%, 2.5%, 2.4%, they'll cut, right? And so that's big. That's a big change in kind of what they're up to there, right? Alrighty, so let's start going through the action out here, which, man, do we have a lot of action out here today, folks. Obviously, all hedges down across the board today on a very green day like today. I'm not going to rush out of those hedges, though. I need those for next year. As far as AI-related stocks, Adobe is the worst stock of the bunch. They do report earnings here in just a bit. About 25 minutes from now, Adobe earnings will be hitting, so we shall see what Adobe reports. Obviously, Adobe's a phenomenal company. But that is the worst stock of the AI bunch here today. Microsoft's down once again. Trade Desk up today. Oracle up today. I reacted on the reaction channel a few hours ago to a video where Truist basically says Microsoft stock is going to $600 a share over the next 3 years is what they were saying. And I thought they made a pretty good case for 600. I wouldn't bank on it, but I could see it. I could see it being 500, 600 in 3 years from now. I think that's a possibility. Meta's very weak today, very slight gain. It feels like, when I look at some of these moves, it feels like what? It begins with an R. Rotation. That's what it feels like. From some of these big dogs into some of the more small caps, mid caps, maybe some of the underperformers, some of the stocks that have been pressured with rates, with a Fed that's obviously been very, very hawkish up until now. And so some of this feels like rotation with some of these stocks actually not performing that good. Look at Amazon. Amazon's up 0.5% today. Nvidia is not even up 1%. But then you look down here and you look at a PayPal, and guess what? PayPal's the best of big tech today, up over 4 percentage points, right? Clear as day, there's money rotating into a PayPal here today, right? All right, JB's on now. Let's hear what JB has to say.
Firmly dead.
No,
at this point.
no. The 2023 bear case is dead. The 2024 bear case is still ahead of us. There are probably going to be reasons to be concerned, but right now, as we end the year, you think about all of the things that went bump in the night, all of the things that we focused on day after day that could go wrong. None of them went wrong. They still could. They haven't. That's the story of by the way, the story of 2023, a lot of conventional wisdom got turned on its ear once again. One of the big ones, I was talking with a housing market expert yesterday. You had Fed funds, essentially, you had mortgage rate go from 6% in February to over 8%. It actually started from 2.6% 2 years ago. What did home builders do this year?
All-time highs.
Up 50% on the year. That's not supposed to happen. A lot of things that weren't supposed to happen. And the big story, the Fed was not supposed to be able to, quote unquote, win the war on inflation without costing us any jobs and without throwing us into recession.
Because as the Fed chair, and I thought this was interesting too, and we didn't get to talk about it yet, in the news conference, he was discussing why in his mind the inflation that was caused in this cycle wasn't traditional. It wasn't caused by some out of control demand. It was caused in many respects by supply shocks. Sure, you can criticize the fact that they waited too long. They were buying mortgage bonds when mortgage rates were low. And you can criticize the government for piling on with a lot of the stimulus, but in many respects, maybe the reason why we're even having this conversation is because those things happened. And the reason why he can maybe declare victory at one of these next meetings is because better late than never.
I'm going to have to hedge heavier against Toll. If that baby keeps running all the way through year end, I'm going to have, in early 2024, I'll have to hedge more against it. And the reason being is if rates are going to truly go down, mortgage rates going to go down, guess what? Inventory will start picking up quite substantially, and the home builders will start having some competition there.
70s inflation paradigm was the wrong paradigm.
Not yet.
Not the only person, obviously, that pointed this out, but I still think it's really an important lesson. The real paradigm to have focused on was post-World War II. We had tons of stimulus in the system. That's what was necessary for the arming of the country and the world against the Axis. That inflation took like 10 years to work itself out of the system. We had rising rates throughout the 1950s, and yet stocks were able to work, and we didn't really have any meaningful economic issue. That was the right paradigm. We had this massive burst of stimulus to make sure that society didn't tear itself apart, and we told people to stay home. It worked. We actually did too much of it, but it was not this lingering issue in the way that it was when we had oil embargoes and the like. It was man-made. We created it, and we were able to allow enough time to go by for that inflation to moderate. And it's not fully out of the system, and people are still paying high prices for shelter, for healthcare. Auto insurance sucks. I get it. I'm not saying like everything's great. Considering how much worse things could have been in this fight to bring inflation down from nominal 9% back on the road to 2, it could have been way worse, and it wasn't.
I mean, we're not, and that goes to, and we're not insensitive at all about the layoffs that have been announced, which layoffs continue to be announced in some respects.
On a net basis, thankfully.
Not to the degree at which some suggested at this point, at least in the cycle, of both an economy slowing and a Fed hiking, that the worst case projection.
Judge, last thing on this. You have 8.6 million open jobs. If you were ever going to be laid off, this is not the worst time for that to happen.
Certainly.
Of course, we
100%.
care. On a net basis, we did not have to throw millions of people out of work to tame inflation. That is the story of the year.
So let's do this. Stay with us. Let's take a quick break.
Now, another reason why, let's call it the stock market can go up or be very excited outside of, all the obvious things we always talk about, right? One of the things the market gets really excited about when they, hear about rates potentially going down is, guess what? Margin, right? Margin, the amount of money on margin in the stock market has gone down, I think a couple $100 billion. Let's see, margin debt outstanding on stocks. No. Google's always trying to get me to give them all my crap, man. Let's see this one here. So this is through October, basically the end of October, okay, is what we have data for. So this is where we peaked in terms of how much margin debt was outstanding. Right there. That was October 2021. $935 billion. And then you fast forward 2 years and we dropped $300 billion of margin debt. Why did that happen? Well, I mean, it's twofold, right? The first thing is margin debt got a lot more expensive. Back here, you could take out margin for stocks 2-3%, 4% maybe. Here, you're talking about margin rates of 8% plus for the most part, even if you're a high net worth individual. And so it completely changes the dynamic in terms of taking out margin. On top of that, obviously, you're in an insanely bullish time at this period, and we can call it just a lot less bullish time or exciting time, right? We got all the way down to here, December 2022, 606, right? So, but the bottom line is basically in a 2-year span, $300 billion of margin debt got wiped out, right? And so Now, if you're talking about a lower interest rate environment, well then, and some investors start to consider, okay, maybe I can start taking out some margin again, right? Which, is basically investing, money you don't have on stocks, but people do it, right? And so the bottom line is that is something that I think factored in. And when you had this big come down here, it's not coincidental that the stock market dropped off a cliff during this 6 to 9 month span, right? Look where margin debt went. In a matter of months, we went from $935 billion of margin debt to $683 billion of margin debt, right? About $250 billion of margin debt got wiped out in a matter of months. Months. And so it's not coincidental that, guess what? If you were to pull up the stock market from that exact time frame, you will see the stock market tanked. Now, if interest rates get better, people feel more comfortable on margin, then it could start going up, right? That's interesting. Margin debt as a percent of the Wilshire 5,000. Wow. But they only have it to April. That's weird that they haven't updated it that long. But anyways, that's still a really low number. That's pretty incredible. Margin debt, yearly change in billions. Oh, I need to plug in my computer. My computer is low. Battery. So we can call it break-even-ish, I guess, recently. But look at that drop there. That's the drop we were talking about earlier, right? Here, look at this. Massive pickup in margin debt. Why? Well, they dropped interest rates to nothing, right? On top of that, you had a huge bull cycle in the market. Everybody excited. Everybody at home. And everybody wanted to make as much money as possible. So people started margining out money, right? Yearly percent change margin debt. Oh, this is an interesting one. And they got this one all the way to October. I like this one. I like this. I like this one. So if we pull up this here, you're looking at margin debt as a percent of the S&P 500 all the way back to levels we were kind of in 2003, 2004. That's intriguing. Really intriguing. Wow. And if you're wondering why did we see a market go down substantially and yet margin debt went up substantially, right? Well, also remember, Fed dropped rates down to zero. So a lot of people said, okay, the worst is behind us with the recession, time to margin out. And so that's why you saw margin in pretty elevated place for several years because the Fed kept rates at zero. And it was kind of like, the employment picture just kept getting better. The stock market just kind of kept getting better for years. And so ultimately, margin debt as a percent of the S&P 500 ended up being in a very elevated place, right? Then we had a big drop down. Then we had a big kind of uptick there. And then now we had the most recent big drop down. So remember, we're at $635 billion of margin debt. Okay. And keep in mind, the stock market gets bigger and bigger as time ticks on. So technically, margin debt should be a much bigger number, let's say, nowadays than when the stock market was 50% lower than it is today, right? So we're at $635 billion. The first time we went over $600 billion of margin debt was in 2017. It looks like September 2017. And that was 606. So, and obviously the S&P 500, the NASDAQ, everything was far lower back then than it is today, right? But remember, 2017 was a very different interest rate level than currently what we have, right? So that makes me feel very comfortable. I'm going to take a screenshot of that as well. So this is just showing you, remember, we're at $635 billion roughly, and of course that's a little outdated because it ended in October, but $635 billion. And the first time we hit over $600 billion in margin debt was back in 2017. So very intriguing. Okay.
Just to let y'all know again, Dow Jones Industrial Average had a new all-time high and could very well close there for the first time ever.
Wow, 37,000. There it is.
36,799 and change is going to get us.
This is when people start really starting to FOMO. is when you start hitting new all-time highs and you start busting through a new all-time high, because that's the type of stuff that gets interest from a lot of people. And then it starts looking real bad if you're a fund manager and you're not investing in this market and you're hitting new all-time highs. Your clients start putting a lot of pressure on you.
In dividends or in a yield with little to no risk. So you'd have to convince people to come out of a 5% yield, and that may happen as the 2-year comes down because it won't be as attractive anymore. You have to convince them to come out of a 5% yield with little to no risk into parts of the market. I think the expectation on some is parts of the market that are already overvalued. I don't think that's going to happen. And I think you see sort of a slow flood from money markets as rates come down. But I think he's right. It doesn't all go into tech. It doesn't all try to jump on a bandwagon. It probably goes into the more attractively valued areas of the market. But we talked about this the last time I was here, too. That's the tipping point. If money comes out of money markets and people have enough risk appetite
Look at
to
the Russell. Look at the Russell Wilson.
Not just utilities, not just staples, cyclical sectors, and credit and high yield.
A 3x of the market.
That tips us into maybe we breach the all-time high. You've got a rally that looks a lot more durable.
Josh, the Russell, better than 3%. It's 3 1/3% right now, approaching 2,000 on the Russell 2000.
I mentioned Adobe earnings are out. That stock is down more than 7% right now in overtime. Pippa Stevens has the numbers. Pippa.
That's right, John. The stock is down on weak guidance, but starting here with Adobe's Q4 results, the company did beat on the top and bottom line, earning $4.27 per share adjusted. That was 13 cents ahead of estimates. Revenue coming in at $5.05 billion. That was slightly ahead of expectations. But once again, it is that light guidance. So for full year, between 21.3 and 21.5 billion. While Wall Street was looking for 21.73 billion. The conference call does kick off at 5 p.m. and right now shares are down about 7%. Back to you.
All right, Pippa Stevens, thank you. Morgan, we said yesterday on overtime.
Yeah, I do worry a little bit if Adobe could be potentially getting disrupted as we speak right now. I'm not sure how much you guys have played around with a lot of the new softwares and programs out there that, will basically let you, have AI images be generated and you don't have to actually do anything, right? Adobe and their Photoshop product, that was such a huge beneficiary for, the past 10, 20 years and really on the back of that was how you had to do things. Now it seems like there's a lot of competing services. I even see Meta has some products out there. They'll basically, you want any type of image to look a certain way, you can basically draft up, and I think those are just going to get better and better. And so you do have to wonder, is that somewhat of a competitive threat to Adobe? Are there other places Adobe's going to be, let's call it disrupted over this next 10 years? So Adobe's a really great company, but I am at least a little concerned with that. In a light fiscal year 2024 revenue and EPS guide definitely kind of gets a little more into the fear about, are they being disrupted right now? So
Out for a conservative guide on Adobe, but there's more to it, I think, than just conservatism here, because if you look through the numbers, the digital media business for Q4 actually came in slightly above the guide and possibly above where some were expecting at $3.72 billion. It was the digital experience line of business that came in even light, really, of guidance at $1.12 billion to my eye. And digital experience is that part of the business that's taking data within a business, and the business itself uses that to get smarter about its operations and about dealing with customers. That's really a very enterprisey piece of what Adobe does with data.
Interesting.
Also in the Q1 guide, you've got
interesting that would be a weaker segment for them. That's really interesting.
Overall revenue, yes, is a little bit light, but the digital media expectation was for $3.84 billion. The guide is to let's see, I think right about that number, maybe a little higher. And the digital experience business, again, expectation was for $1.3 billion. They're guiding to just under 1.3 on digital experience. So it seems to be that enterprise data, digital experience piece of the business where demand is lighter, which is some of what we saw from Oracle yesterday. We're wondering which side was going to win out. At least on the operational numbers and on the guide, it seems like that weakening demand in enterprise is affecting Adobe's numbers.
When we start talking about some of the Gen AI tools that they've been rolling out this year, things like Firefly, where does that fit into the segment breakdown?
That's in the part that's strong. You're going to see that in digital media, right? That's the efficiency piece of the story that we were talking about, where some companies have been winning. But we'll have to see what the color is on the call as well. It seems like at least the losses in the shares after hours are moderating a bit. It's now down a little bit less than 7%. Let's bring in senior markets commentator Mike Santoli now.
Anyways, guys, that's going to wrap it up for me today. Tomorrow is a 3-hour beast live stream. 3-hour beast live stream tomorrow. So get ready for that, baby, because that's a real deal Holyfield tomorrow. And the reason it's going to be 3 hours is after the bell, we have Costco earnings. Now, I don't just want to react to Costco earnings. I actually want to listen to the conference call with you guys. Costco is an extremely important company to understand what's going on with the actual U.S. consumer, even what's going on in some international markets. And so I'm really excited to hear Costco's earnings overall. And obviously, it's a phenomenal company, but really interested to hear their intel. So tomorrow, we're going to do a 3-hour beast. So, yeah. And then the main channel tonight, oh, man, that video might end up being an hour. Holy smokes. Main channel video tonight might be like an hour-long video. Like, it's going to be ridiculous. Ridiculous. So, get ready to get your flapjacks flipped, folks. All right, appreciate you joining me. Much love as always. Hope everybody made some money out there. You should have. If you didn't, you're a bear. Appreciate y'all. And, yeah, see you guys tomorrow for that 3-hour beast. And probably see you on the main channel tonight on YouTube. Peace. Much love.